Welcome. This webinar I've entitled Using the 5-Year Treasury to Determine Fair Value for MBS Prices. If you're an MBS trader and been feeling pretty frustrated this last year or two, trying to trade markets that are often choppy and illiquid and looking to find ways to make an extra tick here, pick up 2 30-seconds there, or squeezing a full eighth out just by knowing when to be patient, this webinar is for you. A little background about me. I'm Chris Bennett. Most people know me from founding Vice Capital over 2 decades ago. But I actually got my start in trading in markets when I was 15 back in the late 80s in the commodities futures markets. Traded all sorts of things over the decades, not just bonds, from very liquid markets like treasuries and euro dollars, which with the end of LIBOR are SOFR futures now, and other very liquid things like major currencies and oil and wheat, to some things that really take some work to get good executions on, like cotton and rice or cocoa, and I'm still active in those markets more days than not. But markets are markets. And once you understand how to determine fair value and a true midpoint price on something that often isn't trading tightly, like a number of mortgage-backed securities coupons that we're all originating right now, you'll be able to price and hedge more effectively and never again feel like you're at the mercy of markets that are often operating only in fits and starts. In this webinar, we're going to look at 16 different real-life examples from last month on TradeWeb and see exactly how we can use the 5-year Treasury, which is incredibly liquid, to determine true fair value on current MBS coupons, which are often not liquid or tight, just like the head traders at all the biggest houses in Wall Street do. So first, some of you may wonder, why specifically TradeWeb? Well, there are on average $150 billion a day in mortgage bonds traded on TradeWeb every single day. Actually, when you add in all the swaps and currencies and other instruments that are traded on TradeWeb, that number is $1.4 trillion a day traded on that platform. So whether you're looking at it through Icon, Refinitiv, through Bloomberg, or through another portal, TradeWeb in the mortgage land is really where it all happens. So why do we have this problem now? It didn't used to be, right? And part of the big issue is we have a tendency, because we're from the origination side of things, to look at things as originators, to look at the market as 6s and 6.5s and 7s. But well over 80% of that mortgage-backed security universe are 2s and 2.5s and 3s. We got here to where we are so fast that our supply needs are up here, but almost everything else that's active and traded out there are at the low end of things, at 2s, 2.5s, or 3s. Remember, as originators, we sell about $2 or $3 billion a day, but there's $150 billion a day trading. It's just mostly all the bonds we made 2 or 3 years ago when we refied the whole country, and sometimes multiple times. So why the 5-year Treasury? Isn't the 10-year Treasury the benchmark? Well, it is, but the average mortgage lasts about 5 years. So when you're talking about current coupon originations, the 5-year Treasury is actually typically the area on the yield curve with the highest correlation. On lower coupons, like ones that are trading at 95 or 96 area, it's closer to the 7-year Treasury, and the expected lifespan of rates that are 1.5% below current market are expected to last close to 7 years. And when you get down to all those 2s and 2.5s that we made 2 and 3 years ago, now you're going to move closer to the 10-year Treasuries. The expected life of those securities is much longer. So the Treasury markets, especially the Treasury future markets, are incredibly liquid. The 5-year Treasury actually trades with a bid-ask spread of only 1/4 of a single tick every second of every day. Aside from maybe the first 10 seconds after a big number like CPI or non-farm payrolls, 5-year Treasury has 100 million bid and 100 million offered with 1/4 of a single tick spread every moment of the trading day. That's the real market. And MBS just traded on a spread to those very liquid Treasury counterparts. So the key to determining a true midpoint price, or for something that at the time is trading wide, is to look at that super liquid market that pricing is based off of. In this case, we're going to look at the 5-year Treasury trading to determine exactly where fair value lies. It's not enough to just execute better than screens when it's not getting you to that full value, or at least to that midpoint price. If you're trading size and you've got one or more dealers that are X for a certain coupon, you can even trade through that midpoint price. So for the bulk of this webinar, I'm going to pull up 16 different examples from screenshots on TradeWeb that I took last month and look at a number of real life situations to determine how we read where fair value and where that midpoint should be. Screenshots from TradeWeb. So these are all taken last month. They're from 3 different days that we took a look at. I'm going to try and highlight the things here to make it, as you can see, this is a pretty busy screen here. So I'm going to highlight things that are on there to make it a little bit easier to see. So this first screenshot's going to come from September 7th. It was 8:36 a.m. We got a good market here. One of the things I want to highlight to start out with is where these 5-year Treasuries are. So all the Treasuries are right here at the top of the screen. I'm going to make this a little bit bigger, a little bit easier to see. There we go. Here's that 5-year Treasury. You can see the biggest thing that we're looking for, at least the easiest thing to be able to read, is looking at change on the day. On TradeWeb, the change on the day is based on the bid side of the market. If you have a market that's really, really wide, when they're showing down 2 ticks or up 3 ticks or whatever it is, that's going to come from the bid side of the screen. So as you can see here on the 5-year Treasury, at this moment in time, our change in the day is down 3/4 of a tick, if you guys can see that there. So what we actually have on this particular example is a good market. We've got a 5-year Treasury that's down 3/4 of a tick. When we look to our current coupon securities, things like 6s back here at the time, things changed a lot in the last few weeks. We've got a pretty decent market here too. 6s in September, as we can see, we're 99.18 plus bid, 99.19 plus offer. We've got a market that's only 1 tick wide on the bid-ask side of things. So we know that midpoint price, that fair value on Fannie 6s in September is right in the middle there. That's coming in at 99.19. We got ourselves a really very lovely market here. We're correlated to the 5-year Treasury. The 5-year Treasury is down 3/4 of a tick, if you recall. And these mortgage-backed securities right here are unchanged to down a plus. So correlated very highly with the change in the day on the 5-year Treasury. Now let's fast forward to later on that day, a half hour later. Now we're at 9:09 a.m. I've got all these marked time-wise. We got a case where we've had a little bit of a rally here. We've got the 5-year Treasury, as you can see right here, up 4 ticks on the day. And we got mortgages, just about that same amount. Fannie 6s in September, we've got a super tight market here. We got 99.22 bid and 99.22 plus offer. That's as tight as you get, and we're up 3 plus on the day. So there's nothing wrong with having the 5-year up 4 plus and current coupon mortgage-backed securities up only 3 plus. That just means that those securities have widened out compared to their Treasury counterparts. When we talk about things that are widening and things that are tightening, because we're measuring all the mortgage-backed securities relative to Treasuries, when those yields change, what widening and tightening terms come from the change in yield. So mortgages widening relative to Treasuries means they're slightly underperforming. Mortgages tightening relative to Treasuries, that spread is tightening, means mortgages are slightly overperforming. And you're going to see in a lot of these examples, we do have cases where mortgages widen slightly through the day or mortgages tighten through the day. However, those happen on a longer term basis. They happen over a period of hours. They don't happen on a minute-by-minute basis. Here we go. So we've got a really good market here again. We actually, especially in 6s, even Ginnies have a pretty decent market, and that's not always easy to come by. Over here, we've got Ginnie 6s. A lot of what we're going to look at here in this, as we're sharing screens, is going to be on the Fannie side of things, but obviously Ginnies matter too. Right now, we've got a very good market in Ginnie 2 6s in September, 99.29 plus bid, 99.30 plus offer side. Very good market here. Fast forward just a little bit. Remember, we've got our 5-year Treasury that was up 4 plus, and we've got mortgages up 4 plus. Now, the very next minute, here's what our screen looks like. Wait a second, mortgages are up a plus. How is that? We've got a 5-year Treasury that actually is still up 4 plus, exactly as we had last minute. But now look at this. Now we've got 6s that say they're only up a plus. 5.5 is only up 1. We've got a big old bid-ask spread here. We've gone from the 99.19 bid, 99.23 offer. So the offer side shows the same on TradeWeb, but that bid side is dropped by 3 plus. This chart you see in the middle here, this is the graph of Fannie 6s on there. You can see we just went from 99.20 plus to 99.18. But did the market actually move? No, it did not. Here's our 5-year Treasury. This is what everything is based off of. It's exactly the same as it was last minute. What we had is just the bid side of TradeWeb just fell apart. There's nobody out there putting out a good bid. So if you were to actually go out and get bids and get 99.19, you definitely wouldn't want to pat yourself on the back thinking that, hey, look, I did great. I got screened. You didn't. You got screwed over by about 3 ticks because that's not what fair value is. Fair value did not change. It's that same price that we just saw a minute ago. Actually, even look at our next screen up here. Sorry, I got to move this one here. 10:43 a.m. A little bit later in the day, we've got a case. Actually, here's our 5-year Treasury. We're up 5 plus. We've actually gone up another tick from where we were before. And as you can see from the graph, here's our graph of Fannie 6s. We got things that are showing that they're jumping all over the place. Now, the actual real market did not jump all over the place. In fact, we very slowly, I remember from this day, we gained 1 tick over a period of 1 hour. So you're looking at the graph and you can see that this is a market that's really kind of operated in fits and starts. The offer side of it's remained okay, but the bid side of it continues to fall apart. You, at least by looking at the 5-year Treasury, tracking where it's been and where a tight market has been, it can show you where that fair value really is. So here we're in a decent spot on sixes. It's an okay market. We've got a tick and a half bid-ask spread, and we've got a case where mortgages have widened a little bit. We've got that 5-year Treasury, as you can see, up 5+. And Fannie sixes, we've got an okay market in. We're sitting up 3. That shows you that really we've got a case where during the day now, mortgages have widened out by about a tick, maybe a tick plus. So as we're monitoring the situation and we're seeing prices of the 5-year Treasury move up and down, we're seeing prices of mortgage-backed securities move up and down. We know that at this point, we've moved to a case where we're about 1 tick wider than they were before. Our final chart from that day comes from late in the afternoon at 4:40 p.m. Mortgages have actually made a nice, smooth, steady climb. We finished up 5 3/4 on the day. And again, here's our chart. This chart had Ginnie sixes in there. You can see all these periods of time where it kept falling apart. But if you look now at the end of the day, we've got ourselves a good market. Even on Ginnie sixes, we've got the 5-year Treasury, remember, up 5 3/4. Ginnie sixes, we got a nice market that's only for Ginnies anyway. We're only a tick and a half wide, up 5 ticks on the day. So it's nice to be able to either A, stay away there when we've got cases where the bid side is just dropping off, or at least B, know exactly where fair value is. These dealers, the head traders on those Wall Street firms, they know where fair value is too, even if TradeWeb isn't really showing it there. We finished up 5 3/4 on Fannie sixes in September. We finished up 5+. So in the end, mortgages have kind of finished the day really at the exact same type levels relative to their Treasury counterparts, neither wide nor tight. Our next example comes from a different day, about a week later, actually. On September 16th, we're at 9:22 a.m. Sorry, I got to go to the next one. Boom, here we go. We're at 9:22 a.m. 5-year Treasury today, let's go back up to the top here. You can see the 5-year Treasury on this day, starting off a little bit softer. We're down 2 ticks on the day. We've got kind of a soft market over here. In fact, Fannie sixes, as you can see right here, show that they're down 5+. Well, is that because the market's really widened? No, it hasn't actually. What we do is we've got a bid-ask spread of 5/32 there. As you can see, given where the 5-year Treasury is down only 2 ticks, we shouldn't have a case where Fannie sixes are down 5+. And where we do have a tight market, here in Fannie fives, we got a tight market and we're down only 3. We're never going to have a case where a higher coupon is going to be significantly higher in a rally or significantly lower when the market's tanking than that longer term lower coupon security. If Fannie fives are down 3, Fannie sixes should probably be down about 2, not down 5+, indicating fair value is probably on the bid side about 3.5 ticks higher than where you're seeing it right now. Fast forward a little bit. Now we're at 9:41. Only 2 minutes later that day, we got a case where the 5-year Treasury, here it is right here again, we're down 3 ticks on the 5-year. And we now have a case over here where the bid side has completely fallen apart. We've only lost 1 tick on the 5-year compared to 25 minutes ago when that 5-year was down 2+. Now we're down 3+. And now look at what we've got going on in TradeWeb here. Fannie 6 is showing that they're down 11. They're definitely not. We've got 99.16, 99.27 on the offer side of things. Even Fannie 5s right here, which are down 7, again, because we've got a bid-ask spread showing on there of 5+. Actually, this is 3, yeah, a 5+. We know that's not right. We know the bid side's garbage. We've got to be able to be patient, wait for it to come back. Or if you've got dealers you're working with that know the real market too, if you've got folks that are making their own markets, go ahead and see there. If they're a 99.25 bid, you're going to be able to do some business with them. Fast forward to later today, it's 12:20. We've got a case where that 5-year Treasury has rallied a little bit. We've gone from down 3 ticks to down 1 tick. Again, a pretty steady day. And now finally, we've had lots of good markets on this particular day, by the way. It's not like we didn't have a good market until 12:20 p.m. I'm just showing different examples here. But now we've got ourselves a really good market. We've got 5s with a 2-tick bid-ask spread. That's okay. We got 5.5s at 1 tick. That's a really solid market. 6s, we finally have a really solid market. And again, we've got a 1-tick bid-ask spread. So again, now we can mark, now that we know we've got a really good midpoint, we know Fannie 6s in September have a midpoint price of 99.26+, since we've got 26 bid, 27 offer. So now we can sort of restrike. We've got a 5-year that's down a tick. We got Fannie 6s where fair value is down 2 ticks. So have mortgages widened? They have, but they've only widened by 1 tick. Now we can use this as our benchmark as the market's trading throughout the day. If we do have a case where we don't have tight markets on TradeWeb on things that we want to trade, like Fannie 5.5s or 6s or 6.5s, we can see how it's performing relative to the 5-year Treasury to find out where that midpoint price truly is, to find out where fair value truly is. The next day, sorry, this is going to be actually 1 week later. Our next examples are coming from September 18th, 1 week later. This particular day, again, we're softer by a little bit. Here's our 5-year Treasury. We're down 2 3/4 ticks. Look at this graph. This graph here is actually Fannie 6s. We got a case where we're at 99.16, 99.13, 99.16, 99.13. In the end, the market has not really moved at all. You can, by the way, you can whether you've got a different source for treasuries or not, you can chart treasuries on TradeWeb as well. Just click on here where you've got mortgage-backed security symbols and type in US 5YT equals TWEB. Essentially, US 5-year Treasury equals TradeWeb, and you can pull up charts of that if you don't have other charting software that you're using to take a look at those treasuries. So we've got a 5-year that's down 2 1/4. Look at that graph. MBS, again, we've got ourselves a good market at this particular moment in time. Fannie 6s down. We got a 1 tick market. We're down 1+. About what we'd expect. So mortgages are a little bit tighter to the 5-year, but again, by 3/4 of a tick, we're really coming in exactly where we're expecting this to be. So the real market's only lost when we had these times where, if you're looking at this chart here, maybe it was 4 minutes ago, it was 10 minutes ago, we didn't have a good bid side on TradeWeb. You can know where that real market is because you can see where that 5-year Treasury is. We're going to fast forward a little bit. 20 minutes later, again, we're the same day, 9:46 a.m. We got a 5-year that's actually improved a little bit. We're actually up a plus on the day now in the 5-year Treasury, and we've got mortgages that are performing very, very well. Despite the fact that we've got, looking over here on this side of things, 5.5s, we don't have that good of a market. Same with 6s, we've got a 3 tick market, but we're up 1+ on the day just from the bid side of things. Ginnie 5s over here, I want to take a look at. I wrote in my notes. Ginnie 5s is not an area we have a market at all, but we don't have a case where Fannie 5.5s, Fannie 6s are up 1+, up 2, and Ginnie 5s or Fannie 5s or any sort of low coupon for that reason is actually going to underperform that by that much. We just have a case where we don't have a good bid side there. Later on that day in the afternoon, we're rallying even a little bit more. Here's our 5-year Treasury up 1+ on the day. You want to take a look here? And what's happened, if you look now, this is taken from 130. We have a case where mortgages are significantly higher. Fannie 6s here, we've got a 2-tick market, 1.5 market, and we're up 6 ticks. Fannie 5.5s, we've 2-tick market, and we're up 7. So it's not that the bid side is mispriced, but what's happened is mortgages have tightened substantially to the 5-year Treasury. But again, these things don't happen minute by minute. When you see this on this graph, things falling apart periodically. They happen slowly over time. This is a market that 5-year rallied a little bit, but we had a case where mortgages tightened a tick every hour all day. Now they perform really well. And now we know, though, if we have a case where the 5-year Treasury is still up a tick and a half, and 10 minutes later, we see mortgage-backed securities go from up 6 to up 2, that didn't suddenly happen. What's happened is that we've had a collapse on the bid side of things, and it'll come back. If you have a case where you have a 1-tick market and suddenly that is up 2, then you know that's a real market on MBS. Again, that usually doesn't happen. We see widening and we see tightening, but it happens over a period of time. It's a tick every 30 minutes or 60 minutes or 90 minutes. It doesn't happen by 3-tick chunks. Next examples we're going to take a look at are from that next day on the 19th. Now we got a bad day in mortgages. We had a really nice day in mortgages the prior day. Today, bonds overall are down. We've got a 5-year Treasury that's down 7 ticks. We've got mortgages on Fannie 6s. We're down 5+ right now. We've got a very good market in 6s. We got a 1-tick market here. Again, look at this graph. Here's Fannie 6s. The real market the whole time has been 99.20+, 99.21. We've had cases where the market keeps falling apart. We're at 20, we're at 15, we're at 20, we're at 13. Again, the market didn't actually do this. We just had cases where there weren't people out there making a good market on the bid side of things for those moments in time. 99.15 has never been the real market. The real market has always been up here. They're throwaway bids. And actually, the offer side of the market would probably been fine at this point. It's the bid side of the market that just wasn't being properly sponsored by the dealer community. You look at Ginnie 6s here. we actually have something decent here. Got a 2-tick market. We're about unchanged. Sometimes what will happen here, you kind of think to yourself, wait a second, how do we have a case where the 5 years down 7 and mortgages are unchanged, but Ginnie 5.5s are down 6? It doesn't happen very often, but from time to time, TradeWeb can have a bad mark at the end of a day, and that's what happened here. There's no way we'd have a case where Ginnie 5.5s would have a decent market or even a bad market and be down 6, and 6s would be unchanged to up a plus. This particular day, we just had a case where when TradeWeb took their snapshot at the end of the day, we had a very soft market in Ginnie 2 6s, and so the change on the day is kind of mismarked there. That's something by, because you're watching the screens all the time, you'll be able to tell when that happens. You have to just sort of discount that when you're looking at tracking where fair value is and where that midpoint price is. It kind of varies by coupon sometimes, even though most all the time when they take that 3 o'clock snapshot and what they're showing the change in the day here is the 4:45 snapshot. They're usually making sure that they've got a case where they've got good markets all the way around when they take those closing marks. Our next one, same day, and this is coming from 9:30. We want to illustrate, we've got a 5-year that's a little bit better. We scroll up here, we got a 5-year Treasury that's down 5 3/4. So we're up actually a tick and a quarter from when we took our marks before. But now we've got a good market in 6s here. We're down 4. We've actually tightened up a little bit. Look at 6.5s. So we've got a good market in 6s. We know we're down 4 plus. 6.5s, huge wide bid-ask spread, showing down 10 on the day. Again, like our earlier examples, we're never going to have a case where we've got one coupon with a good market that's down 4 plus, and you've got a higher coupon that should be maybe down 3 plus or down 4 because of those weightings. And instead we're showing down 10. We know for sure that we've got a terrible bid side market there. We may very well have an offer side of the market we can operate in, but the bid side just isn't there. There's nothing there on 6.5s. They should come back. They just haven't yet. Here's later that same day, 9:39. We've got a 5-year that's at, again, about that same area. 5-year Treasury, you can see here, is down 6, so almost exactly where we had it before. And boom, we're back. We got 6.5s that's getting better. We still don't have a tight market there, but we've got 6s that are down 4 plus, 6.5s that are coming back. We're trying to get ourselves back into a tight market. It's a little bit better on 5.5s, not quite there yet. So again, when we're taking a look at how these different things move relative to each other, we're also looking at different parts of that yield curve. Current coupon mortgage-backed securities are going to trade very similar to the 5-year Treasury. When you're looking at things that are down here at, for example, 5s at 96, now is when we start looking at something like a 7-year Treasury, because they're going to move that much more. And if you look at the 7-year Treasury over here, the 7-year on that day was down 8 plus. So we got a 5-year that's down 6, 7-year that's down 8 plus, and that's much more commensurate with where we see those 5 trading. If I can scroll all the way down here, I can't because it's a screenshot, and show you where 2s and 2.5s were. Those were all sitting there down about 10 or 11 ticks, which correlates very well to our 10-year Treasury at down 11 plus. The last one I want to show is from later that day at 12:32. We've got a case where, again, we've got a 5-year Treasury that's at that same spot, down 5 3/4. We really haven't moved hardly at all in the real market this entire time. And we go over to mortgage-backed securities, and now we found we've actually tightened throughout the day. We got a case where that Treasuries are the same, down 5 3/4, and we've got Fannie 6s that it might look like from this chart they're spiking all over the place. In the end, they've actually just, the real market has been a slow tightening. We've just had a few fits and starts where that bid side has fallen apart. But Fannie 6s at a good market here, down 2, while we've got a 5-year Treasury that's down 5 3/4, is a nice eventual 3 plus, almost 4 tick tightening. But again, it's occurred throughout the day. None of these spikes were real. This tightening occurred throughout the day, and now we're 4 ticks better than our Treasury counterparts. And by being patient, you can avoid those markets to trade into that where you're not getting a good bid side of things. So it's important to know the real market, and the real market is that 5-year Treasury. That again, every second of every day, that 5-year Treasury has a quarter of a single tick bid-ask spread. There's 100 million bid and 100 million offered. It takes following it to be able to know that real market. And really, that's really what makes a skilled trader. Offer side of the market we can operate in, but the bid side just isn't there. There's nothing there on 6.5s. They should come back. They just haven't yet. Here's later that same day, 9:39. We've got a 5-year that's at, again, about that same area. 5-year Treasury, you can see here, is down 6, so almost exactly where we had it before. And boom, we're back. We got 6.5s. That's getting better. We still don't have a tight market there, but we've got 6s that are down 4 plus, 6.5s that are coming back. We're trying to get ourselves back into it, back into a tight market. It's a little bit better on 5.5s, not quite there yet. So again, when we're taking a look at how these different things move relative to each other, we're also looking at different parts of that yield curve. Current coupon mortgage-backed securities are going to trade very similar to the 5-year Treasury. When you're looking at things that are down here at, for example, 5s at 96, now is when we start looking at something like a 7-year Treasury, because they're going to move that much more. And if you look at the 7-year Treasury over here, the 7-year on that day was down 8 plus. So we got a 5-year that's down 6, 7-year that's down 8 plus, and that's much more commensurate with where we see those 5 trading. If I can scroll all the way down here, I can't because it's a screenshot, and show you where 2s and 2.5s were. Those were all sitting there down about 10 or 11 ticks, which correlates very well to our 10-year Treasury at down 11 plus. The last one I want to show is from later that day at 12:32. We've got a case where, again, we've got a 5-year Treasury that's at that same spot, down 5 3/4. We really haven't moved hardly at all in the real market this entire time. And we go over to mortgage-backed securities, and now we found we've actually tightened throughout the day. We got a case where that Treasuries are the same, down 5 3/4, and we've got Fannie 6s that it might look like from this chart they're spiking all over the place. In the end, they've actually just, the real market has been a slow tightening. We've just had a few fits and starts where that bid side has fallen apart. But Fannie 6s at a good market here, down 2, while we've got a 5-year Treasury that's down 5 3/4, is a nice eventual 3 plus, almost 4 tick tightening. But again, it's occurred throughout the day. None of these spikes were real. This tightening occurred throughout the day, and now we're 4 ticks better than our Treasury counterparts. And by being patient, you can avoid those markets to trade into that where you're not getting a good bid side of things. So it's important to know the real market, and the real market is that 5-year Treasury. That again, every second of every day, that 5-year Treasury has a quarter of a single tick bid-ask spread. There's 100 million bid and 100 million offered. It takes following it to be able to know that real market, and really that's really what makes a skilled trader. So if you take only 1 or 2 things away from this, it's that Treasuries are the real market. They widen, they tighten, they happen slowly over a period of hours, not minutes. And the reason it matters, you might just think, well, I'm going to get a bunch of bids anyway. I'm just going to get the very best bid and hit that. Things like Fannie and Freddie, their cash pricing is tied to TradeWeb. On very high securities like 7s or 7.5s, they've got it set on swaps to lower securities that they constantly monitor and alter. But a lot of the mid and lower interest rates are tied directly to TradeWeb. So if you have a case where the bid side on TradeWeb is 4 ticks lower, 5 ticks lower than it actually should be, and you're pulling cash pricing and you're executing, you've actually gotten screwed by 4 or 5 ticks when 3 minutes later it pops back up when we've got a good bid again on TradeWeb. So it matters actually beyond just trading mortgage-backed securities. Other things you're going to do are actually tied into it. If you're selling bulks to investors, a lot of those marks they take are going to be also, they're tied in automatically to TradeWeb. You've got to make sure when you're agreeing on prices for mortgages and you're truing things up based on where the market was when you bid it and where the market was when you hit their bids, you've got to make sure that you're both looking at markets that are real markets and not looking at a screen where the bid side is soft by 4 ticks or 5 ticks, and you as the seller are the one who's actually paying that price. So another thing to take out of it really is just, you don't have to be at the mercy of that moment. Good traders at dealers know the real market too. Thanks for watching. If you'd like to talk markets or interested in hearing more about what we do here at Vice Capital, I'd love for you to reach out. Thanks for joining me today, and good trading.